So we are obviously seeing a pretty ferocious bounce back here today with the S&P up about 2%, the Nasdaq up 3.5%, and the Russell 2000 up 3.31%. Some of our favorite stocks that we have been invested in for over the past year that have gotten absolutely beaten into the ground are starting to see a bit of a recovery here over the last 2 days. And the reason for this recovery is actually bad news out of Fed Jerome Powell. Fed Jerome Powell said he cannot control a soft landing and really was sending the message like you're not going to get one, basically saying we are going to get a recession. Now, the markets were firmly pricing in a recession, so the fact that Fed Jerome Powell actually came out and said what the markets have already priced in was actually a very bullish thing, and you are seeing this knee-jerk bullish reaction based off of that. So we need to talk about, is this rally actually going to last? Get into a little bit more depth what Jerome Powell did say, take a look at the news for next week, potential, good and bad data that could come out, as well as the fear and greed index, go over short interest of our favorite stocks, all of that good stuff. So if you guys find value out of this video, hit the like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. Thank you guys for tuning in, and make sure to get your free stocks down below in the description. Not a bad time to get yourself some free stocks considering almost everything is on sale. So like I previously said, Fed Jerome Powell showed a lot of competency, basically agreeing with the markets. The markets, with the Nasdaq down 30% yesterday intraday, was saying, hey, the economy is not so good, things are not going to be good. So why was the Fed essentially saying, hey, we're going to hope for a soft landing, we think there's a really good chance, so on and so forth. Inflation, we need it to come down to 2%, hopefully, 3 to 4% by the end of this year. The markets were firmly disagreeing, and that's why you've seen a sell-off after the last Fed meeting. It's like, if the markets are so far disconnected from the Fed, something is wrong there. Either the markets are wrong or the Fed is wrong, and usually the markets are not wrong. Usually the Fed is wrong. So now you see the Fed kind of ceding to the markets, just saying things are not okay, things are probably not going to be good. So that in turn turns into a bullish thing now that we are more so on the same page with the Fed. But at the same time, Fed Jerome Powell, and this didn't get enough credit in my personal opinion, Fed Jerome Powell said if inflation does not go down, then hey, we will raise rates even more than we project right now. But he also said if economic data starts to slow down, we start to head into a recession, and inflation does start to come down, that we will not raise rates as aggressively, and we will reevaluate the situation every time new data does come in. So I think that was very much overlooked by the markets, but I do think under the surface, if you're considering algorithmic trading programs account for most of the volume on any given day and they really control the markets, that's what is playing one of the bigger roles in why we are seeing this bounce today here in the markets. Just a simple fact. That's a simple fact. Bad news turned out to be good news for the markets because the markets were already expecting even worse news. So we'll see if any new comments come up by the Fed. We have a couple of Fed speakers throughout the rest of the day today, and those comments definitely will move the markets. Now, as far as the fear and greed index, keep in mind, we are still extremely fearful at a 12. Even 1 week ago, we were at 16. So even though we have bounced today quite dramatically, about 3.5%, like I said, in the Nasdaq, you're still extremely fearful in the markets overall, and I really don't think you're going to see a lot of support for this bounce until we get some kind of good data, which is going to be inflation coming down, the Fed potentially U-turning, or just really good economic data overall, which we're not really going to get too much of that this week. We will get a couple key points, which I will go over for you guys here in this video, but all of these basically indicators of the markets besides the VIX is in extreme fear territory. The VIX is actually neutral, coming in at about 29.33. Now, a lot of people were saying that we cannot find a market bottom until the VIX really gets above 30, around 40. Now, in my personal opinion, if you understand the VIX, and the VIX is basically the the fear gauge, right? It monitors the amount of puts to calls on the S&P 500. The higher the VIX is, the more puts that are on the S&P 500. And puts are considered not a gambling tool, but insurance. So it's like, why would you buy car insurance or home insurance if you did not own a car or a home, right? Use that analogy in the stock market. I don't think a lot of people are too heavy in equities right now. I think a lot of people have a lot of cash. So for an example, if you had 50% cash, 50% stocks in the stock market, what's the point of even buying insurance on that? You wouldn't buy insurance on half a car, right? So I don't think there was a huge need to go out and buy a lot of puts, and I think that's why we are actually seeing this bounce without the VIX actually breaking out into a new high. There's no point, in trying to protect a portfolio that is mostly cash. If you're in cash, you're already protected, right? You haven't really seen this market downturn, obviously, in the same way. You can argue inflation all you want, but when it comes down to it, if you can buy 5 times more shares in some stocks than you could have a year ago, have you really lost money to inflation? Probably not. Now, if you're out there having a hot girl summer, going crazy, going wild, and traveling and all that, then sure, you lost money to inflation, but not in the stock market. The stock market has been very deflationary as of late. So there is that. All the indicators still in extreme fear. So point is, there's still a lot of room to have a quite substantial bounce here still in the marketplace. And I want to see where we end up by the end of the day today. If we do actually break down and hit a new low for the day heading into the close, that's not going to be a good thing. But if we can actually rally into the close, somehow find a little bit of steam here in the last 2 hours of trading, that will be a very, very bullish thing heading into next week. Because after all, if you're going to sell out and de-risk your portfolio, you do that on a Friday, because anything can happen over the weekend. This is as old as the stock market is itself, this saying. You do not want to hold over the weekend during times of volatility. So if you essentially see a lot of people sell out heading into the weekend, like you're starting to see a lot of selling actually coming through right now, then that is not a good sign. If you see the opposite, somehow a lot of buys start to come in and the stock market does start to rally, that is going to be a very, 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 very bullish thing. And that is the biggest thing that you guys need to pay attention to if you have trades here in the markets going into next week. I'm not sure why we are actually selling down right now, but taking some pretty big candles to the downside. So very important to pay attention to that. Now, the data that we do have for next week is actually very, very interesting. So you have virtually nothing on Monday that will move the markets. Now on Tuesday, you have retail sales month over month. That could be very important to kind of give us an indication of, are we heading into recession or are we not? Retail sales are going to be a very important thing to watch as far as potential recession indicators. And then on Wednesday, 8:30 in the morning, you have some real estate data, building permits, APR, housing starts, APR. That could move out around some real estate stocks to a certain degree. On Thursday, you have existing home sales, again, more real estate data. And then on Friday, you don't really have too much. You do have the oil count, so that could be big. The rig oil counts for obviously oil, so that could be good for oil stocks to a certain degree, but not too much actual activity for next week. Lots of real estate data, but that is pretty much it when it comes down to it. There's nothing that is too mind-blowing. So really based off the sentiment here, we're either going to see that continued bounce or we're going to see that continued drop, like we are seeing a drop right now, and we're now under 400. So that's really not a good sign that we cannot hold above 400 today. We'll see by the end of the day. That's going to be very, very important. We did hit 395.61 on the S&P at the lowest point today, and we are just breaking down in a massive way right now. Absolutely mind-blowing the way this market is so bipolar and just doesn't understand where to value stocks. And I think the biggest part of that is, when there's fears about growth slowing down and we just had earnings, you have 2.5 months until we have earnings again. If people are starting to expect that companies are slowing down in a massive way, then where do you value these stocks? It's very, very hard to come to a reasonable valuation if you don't know how they're going to perform in the next year, possibly in the next 2 years. So I think once we really do find a breakdown in the markets and really do hit new lows, I think it's going to be due to earnings. Say Apple, if they completely miss earnings and they drop 20%, well, Apple is like 13% of the NASDAQ. So that's going to bring down the NASDAQ by over 1% alone, just Apple, not even considering other stocks. So I think that's the biggest thing that is really going to be the biggest market moving events this year. It's really going to come down to earnings, all things said and done, and as well as the Fed, because after all, think about it. If the Fed raises rates to infinity, it doesn't really matter if companies are still doing very, very well and beating all estimates. The Fed raising rates like that, not good for sentiment, but still, if the fundamental valuations hold up, all things are fine and dandy there, and it looks like we are drilling into, oh man, this is going to be nasty. This could be a nasty close, guys. So not looking so good, not looking so hot here today. Let's just be honest about that. Now let's talk about SoFi stock, and SoFi is definitely catching a lot of bids today, up 15.20%. And this goes to show a couple things. It goes to show that SoFi is actually a great business. The earnings were great. The market sentiment as of recently has not been great, so you can't even get rewarded for good earnings like SoFi had. But when the sentiment changes around, you tend to get a lot of those built up orders that tend to go in at the same time. Now, on the other hand, with SoFi, you did get, obviously, like I said, the Fed actually admitting that they were wrong, that the economy is not in such a good place. We're probably going to get a hard landing. That is obviously bad news, but it's good news for SoFi, because SoFi can still perform very well even given the market conditions they are currently faced with. So I think this could only potentially be the start of a major bounce that we are going to see in the stock. We really got to break above 795. That is going to be the 50-day moving average. That is a level that we have had extreme resistance at in the past, right here, right here, right here, and in here. So 4 or 5 times now we've tried to break out past the 50-day moving average and got rejected at those levels, and she likes SoFi stock as well. This is gonna pay for your college, okay? Okay. She said okay. But really, one of the big problems that is facing SoFi stock and a lot of the stocks that we invest in, these hyper growth companies that are going to be massively bigger in the future, is essentially investors don't know what to pay for long duration growth, because there is growth concerns. There is a growth slowdown that is currently happening. We don't know how long that will last. We don't know how hard it will be. So it's like, how much should you pay for stocks that won't be profitable for a couple of years? Now, SoFi will be free cash flow positive, and they are free cash flow positive by the end of the year in a more substantial way, but I believe they will turn a net profit in 2023. So it's like, how much should you be willing to pay for these stocks? Do you give them a 10 times earnings multiple? Do you give them a 30 times earnings multiple, a PE ratio? Nobody really knows, and that's why you can see these back and forth wild, 10-15% swings on any given basis until we get inflation coming down and the Fed kind of starting to U-turn or step off the gas pedal of raising rates to oblivion. Then I don't think you'll see a lot of stability in what people are willing to actually pay for stocks like SoFi. But nonetheless, that's where the opportunity comes in, because if you are a savvy investor and you are in here buying the dip on a lot of long-term or it's called long duration growth, you can look at it just as long-term investments, stocks that 5-10 years from now will be much bigger, but they're a lot smaller now. Long duration growth, once that stabilizes, once inflation comes down, the Fed either starts to U-turn or the economy does not go into a bad recession, that's when you should find more stability in a lot of these stocks and just an overall uptrend from these depressed levels that we have seen as of recently. Now let's go ahead and take a look at SoFi stock with the Ortex data. You gotta love this platform. They give it to us just how we like it. No pun intended out there. Short interest of free float is 21.24%. Current shares that are sold short of 154.61 million. Cost to borrow max of 14.91%. So the cost to borrow is very, very high on SoFi stock. The minimum is 3.38%. The max is 14.91%. That's a wide range, and it means it's very expensive to get a short position on SoFi stock. And the short interest at 21.24% is very, very high in the grand scope of things. That's why you can see big moves like this. But even for today, you're still seeing 5.4 million borrowed shares and return shares at about 700,000. So you're still seeing almost 10 times the amount of shorting today comparatively to shorts actually covering. So it's gonna be a wild road when you have short interest that high, pessimism so high in the stock market, in the overall economy. But in the long term, I think you'll be just fine with SoFi stock. The utilization is at 100% and days to cover is sitting at 4.19. So when a short squeeze actually does start, 4 days to cover is a lot of days to cover. Now, the option activity for the day is 13 orders totaling $2.48 million, positive order value of 57%. So that is also not helping to push SoFi stock up when you're seeing all of these puts that are close to the money coming through on the option chain. It forces the market makers to go out and short more shares of stock. So that is pretty much the recap that you guys need to know for the day. Watch to see the biggest thing. Watch to see right now if the markets do catch some steam as we do head into power hour and we can close at the higher end levels. If we do break down and continue to sell off into the close like we kind of have been doing for a while here, it's not going to be a good sign, because overall Fridays can tell you a lot. If people are really feeling risk on, then you'll see obviously the markets run into the close, and then you're likely to see the markets continue to run next week. If you sell off into the close, not going to be such a great thing at all. So that is going to be all for this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. But most importantly, you guys enjoy your weekend. You definitely deserve it, and I will see you in the next one.